Hi, everybody. Welcome back. I want to introduce you to Charlie Miller of Fortress Mortgage, another great resource that I have for you first-time home buyers, move-up buyers, downsizers, whatever you are. So, Charlie, take it away. Let's talk
Yeah,
lending,
lending.
buying a home.
So I'm Charlie Miller. I'm with the Fortress Group, Total Home Finance. We are a mortgage company based out of Montgomery County, Maryland. We're a small brokerage, family owned and operated. And we're licensed, I'm personally licensed in DC, Maryland, Virginia, and Delaware. But my team is also licensed in Florida, the Carolinas, Texas. So if you have anybody that's not looking in the Mid Atlantic area, we also can help with that.
Great.
But today, I guess we want to just talk about a little bit what goes into qualifying for a loan.
Yeah, let's
Yeah.
let's talk about, for the first-time home buyers out there,
Yeah.
what they need to do.
So keep it simple. When you're looking to, the first step is always to speak with a mortgage company. The
Yes.
last thing you want to do is go out, look at properties, find something you love, and then realize that you can't afford to buy it. It's just heartbreaking. It's not fun. It's a waste of everybody's time, including yours.
Correct.
So what we want to do is we want to look at your specific situation and see what product fits best for you. So there's three main things that a mortgage company is going to look at. The first thing is your credit scores and your credit history. We use all three credit bureaus, Experian, Equifax, and TransUnion. And mortgage companies just use the middle score of the three. So if your three scores are 710, 720, and 750, we just use 720 to associate towards qualifying. The better your credit, the easier it is to qualify, and the better rates will be. The worse your credit, it can be a little bit more difficult to qualify, and rates can be a little bit higher. So credit's the first thing. Now, one thing to be aware of with credit is based on what's called a FICO algorithm. And FICO technically has 8 different algorithms depending on why your credit is being pulled. So that's important because you might pull your credit and say, hey, Charlie, I've got a 760 credit score. That's great. And that's a real credit score, but it's a proprietary score from one of the credit bureaus. It's not based on you acquiring new debt like a mortgage. So when a mortgage company pulls your credit, it's a different FICO score than when you pull it yourself. So that's kind of a big thing.
I didn't realize that.
Yeah, so there's 8 different algorithms. And so when you're looking at that, if you pull it for a car loan, it'll be different than when you pull it for a student loan, then a credit card, then a mortgage. So it's something to be just aware of. So you're not surprised if a mortgage company pulls it and you're like, well, why is my credit score different than when I pull it? So it should be similar, but it can be a little bit different because, or for the intended use of the credit inquiry, I should say.
Okay.
So that's the first thing, your credit, your payment history, and your track record. Second thing, where is the money coming from for this transaction? So when you buy a house, you're always going to have some type of money set aside for a down payment and closing costs. Now, where that money is coming from is really what we care about.
Not the money stuffed in the mattress.
Right. So let's see. The Patriot Act, anti-terrorism laws require mortgage companies to document where the money is coming from for the transaction. So if you have $10,000 on your mattress, you go deposit that in the bank and you give us your bank statements and we see that $10,000 deposit. If we can't source where it came from, we can't use it for this transaction. So that's important to be aware of. We have to source where all the funds are coming from.
So if it's a gift from your parents,
Absolutely. Gifts are absolutely acceptable for every single loan program.
because you can source where it came from.
Exactly. So all we would have to get is a gift letter from you and the donor stating that's a gift and show that it came from them. So gift from a family member are completely fine for every loan program. Borrowing against a retirement is a big one. And this is kind of becoming even more of a larger one because you've seen the average age of first-time homebuyers jump from 33 to 38. And by the time people are 38, a lot of times they've had career jobs or have saved up money in a 401k, and they don't realize that they can use that for a down payment and closing costs.
Oh, wow.
So you might not be as far away from how much cash you need for the transaction as you think.
Okay.
And you can do it without liquidating it. So you leave that money invested, you just take a loan against it and pay yourself back. Now there's interest and some fees. You want to make sure it makes sense for your situation, but can be a very real and viable option.
Nice.
Down payment assistance programs, now just to be kind of determined based on where you are. Every county and every state are going to have their own programs where they can get assistance for down payment and closing costs. So we just have to make sure, first thing, your payment history looks good with your credit scores. Then where's the money coming from for the transaction when it comes to a down payment and closing costs? The third thing we look at is your ability to repay the loan. So can you afford this based on your debts compared to your income? So we have to make sure that all your current debt payment history, your car loans, student loans, credit cards, plus the new mortgage payment you're acquiring, you have enough money to satisfy that and to be able to not be house poor or be to the point where once you pay your taxes and buy groceries that you're really in a tight spot. So we also look at your debts income ratios. There's kind of a different avenue that we look at with different loan programs with that. There's a housing payment ratio, so your new mortgage payment compared to your total gross income, and then your total debt to income ratio, which is everything else: car loans, student loans, credit cards, plus the new mortgage compared to your gross monthly income. As a general statement, we like to see your total debt to income ratio somewhere in the mid 40s, somewhere in that 45%.
Okay.
Now, there's a lot of nuance there, right? It could be a little bit tighter depending on USDA loans. It could be much more lenient on VA loans and FHA loans. So you're not stuck to one specific number. But that gives you kind of a baseline of, if you said, okay, I make $10,000 a month, that means all my debt should be somewhere around that $4,500 a month kind of area. I have a $500 car payment. I've got $300 in credit cards. It means I could probably qualify for a $3,600, $3,700 mortgage payment. So there's qualifying, and then there's comfort level. So that's a big one.
Yes.
So you want to make sure that what you're qualifying for, A, that you can qualify for it, but B, that you're comfortable with it. That's really the important thing. Everybody has their own comfort and risk levels that they're willing to take on a monthly basis from an obligation perspective. And you really want to jive those two things together. So that's what we always say. Okay, well, here's a rough idea of probably what you could qualify for. And here's really what you told me you're comfortable spending. So let's work that and correlate that back to a price range that you should be looking in.
I like that.
Yeah. So credit scores, where's the money coming from? Can you afford it? And do you have the ability to repay the loan? After that, we'll take, based on that situation, and then in your specific scenario, we take all of that and we kind of tailor what loan program is best for you. So if you're a veteran, VA loans are by far my favorite loan program. They're the best program that exists. You can do 100% financing, so no down payment. There's no mortgage insurance, and they have very, very good rates. And they're also very lenient qualifying wise. So you don't have to have great credit. You don't have to have a ton of money set aside in reserves after closing. It's just a pretty easy loan to qualify for. And the goal is to help get veterans into homes.
Yes.
So it's a great product. You have to meet certain service-related, duties and timeframes. We verify that with what's called a certificate of eligibility from the VA. So whenever you're getting a VA loan, that's the first thing that we'll pull. So VA is great. So if you're a veteran, that's definitely the first conversation you're going to want to have. Second thing is FHA. FHA is another government-sponsored or subsidized product. It stands for the Federal Housing Administration. The minimum down payment with FHA loans is 3.5%. So if you're looking at a $300,000 home, the minimum down payment will be $10,500, right? Okay. So you'll have to come up with that. That can be the gift funds. That can be the retirement. That can be a down payment assistance program. But that's the minimum down payment. Okay. FHA is also very lenient when it comes to qualifying on credit scores and debt to income ratios. So if you have kind of are beginning and haven't established a great credit history or a great credit score, FHA can be very, very favorable with interest rates and qualifying. The one downside to FHA is it has two types of mortgage insurance: a one-time upfront mortgage insurance and a monthly mortgage insurance, and you have to pay both. Oh. But the rates are very, favorable compared to conventional financing, and it can be, again, very lenient from a credit perspective and more lenient on debt to income ratio standpoints. Okay. And you have conventional loans. So conventional loans, you may have heard of Fannie Mae and Freddie Mac. Those are large government-sponsored entities. They insure, guarantee these conventional loans. So minimum down payment for first-time home buyers or people that meet certain income restrictions is 3% of the price of the home. If you're not a first-time home buyer, or if you don't meet income restrictions, then it's 5%. And that's typically the products you're going to go with if you're putting 5, 10, 15, 20% down. Okay. Because you avoid paying mortgage insurance. So a quick caveat on mortgage insurance. Mortgage insurance is not a good thing for you. It's an insurance policy that protects the investor because you don't have more equity. So against you defaulting on the loan. So if you stop making payments, that insurance policy would help cover some of the losses associated with carrying the property. So it's not something you want. The only 100% true way to avoid mortgage insurance entirely is to put 20% down on a conventional loan. Okay. But you can still do, that's where that 20% kind of comes in, and people think, oh, I have to do 20% down. No, you don't. You can do 3% down. You just will then have a mortgage insurance. And there's different ways to pay that mortgage insurance. You can pay it monthly. You can buy it out up front. The lender can pay it for you, but they build it into your interest rate. So there's a lot of different options that you want to have a conversation with us on when you're exploring those things. So VA loans, FHA loans, and conventional loans. There also are USDA loans. It's a great product if the property is eligible for it. So for USDA financing, you can also do 100% financing, so no money down. But there's a lot more nuance to that one because the house has to be located in an eligible area. So it kind of restricts what you can look at. But if you have any specific questions or you're looking more rural areas, we can always take a look to see if the house is eligible for USDA financing. So it really what I'm hearing is that as a first-time home buyer or any home buyer, you really need to talk to your lender, Charlie here, to see what the different programs are and what fits you.
because what fit your friend or your sister or brother may not work for you. You might need something a little different.
Absolutely. And the last thing we'll talk about real quickly is monthly payments. So, what goes into a mortgage payment? You may have heard the acronym PITI. So, it's principal, interest, taxes, and insurance, and then mortgage insurance if you have it. So, principal and interest is to pay back the loan and the interest you owe on the loan. Then you have what's called an escrow account. An escrow account is where a mortgage company collects your property taxes and homeowners insurance for you as part of your payment and then pays that for you when they come due. So, when you own a property, whether you have a mortgage or not, the state and the county are going to charge you property tax for owning that property. And then you're going to want to maintain and keep an insurance policy, so a basic fire and casualty policy. So if the house was to disappear, that you could replace it. What we do is we take what that annual premium is for your homeowner's insurance. We take what the tax bill is. We divide it by 12. We include that in your mortgage payment. It accrues throughout the year. Then when your taxes and insurance come due, we use those funds to pay them for you. That's called an escrow. We're escrowing for tax insurance and paying them for you when they come due. So principal, interest, tax, insurance. And the last thing you'll have is mortgage insurance. And we already kind of went down that. So,
Yes.
and we can talk about mortgage insurance at, when we have more of a one-on-one in-depth conversation about ways to get rid of it, how to avoid it, things of that nature.
Perfect.
Yeah, documentation-wise, real quick, 222, whenever you're speaking with a mortgage company and you go through the pre-approval process, the easiest way to remember it is 222. So 2 pay stubs, 2 W-2s, 2 bank statements. So your most recent 30 days of pay stubs, 2023 and 2024 W-2s. This is, if you're looking at this video 5 years from now, it would be the subsequent 2 years. And then 2 months of most recent bank statements. If you own other properties or if you're self-employed, then it gets a little bit more involved from a documentation perspective. We can always talk about that as well.
Very good.
Cool.
Well, thank you very much, Charlie.
Yeah,
really
thank you for
appreciate you
having
being
me.
with us. And that was a very quick little overview of programs and lending. And obviously, what I always say is you need a one-on-one with your lender, with your agent to know really what you're doing and going into this. Thanks so much for joining us.
Yeah, thanks for joining us.